Welcome to the Deep Dive. We're the show that helps you cut through all the noise, stack up the information, and really pull out those nuggets of knowledge you can use.
That's the plan.
Today, we're heading a bit off the beaten path, going beyond your typical stocks and bonds.
Yeah, way beyond.
Our mission to unpack the, well, often misunderstood world of alternative investments. We're talking things like exchange-traded funds, ETFs, and real estate investment trusts, or REITs.
Right.
And then the really complex ones, direct participation programs, DPPs.
Those can get dense.
They really can. But our goal here is to make it interesting, genuinely interesting, and give you a shortcut to feeling well-informed.
And that shortcut is, well, it's pretty crucial. Because these aren't just niche things. They're completely different ways to put capital to work.
Different mechanics.
Totally different mechanics, unique risks, potential rewards, fundamentally different from traditional stuff. Understanding those differences, those nuances, that's key for making smart decisions.
Okay, let's dive in now. Let's start with something maybe more familiar for a lot of people. Exchange-traded funds, ETFs.
Good starting point. They've exploded in popularity.
Absolutely.
Yeah.
And they're basically these packaged products, right? They track a basket of securities, often an index.
Exactly. Like SPDRs for the S&P 500.
Or QQQs for the NASDAQ 100, or DIA for the Dow.
Yeah.
Classic examples. But the big difference from mutual funds, and this is important, is they trade all day long on an exchange.
Right. Price is changing constantly with supply and demand, not just once at the end of the day like mutual funds.
So what about costs? And, who's actually managing these things?
Well, you've basically got two main camps. Passive management is one.
Just matching an index.
Exactly. Just match the index performance. Lower fees usually because they're not trying to actively beat the market.
And the other?
Active management. That's where you have a professional team picking securities, trying to outperform. Costs more, as you'd expect.
Makes sense. And for me, the investor buying these.
You're typically paying a brokerage commission when you buy or sell ETF shares. Different from mutual funds where you might see sales charges.
Okay, now here's where I think it gets really fascinating, especially if you're looking beyond just the standard stuff.
Ah, the specialized ones.
Yeah,
Yep.
inverse and leveraged ETFs. What is the deal with those?
Right. These are, well, they're definitely more complex tools, not your standard buy and hold.
How so?
Inverse ETFs are designed to go up when the market goes down.
So betting against the market.
Essentially, yeah. If the S&P 500 drops, say 1.5% one day, the inverse ETF tries to gain about 1.5%. They use things like short selling or derivatives to do it.
Okay, and leveraged.
Leveraged ETFs try to amplify the returns. They use debt or derivatives to give you a multiple, like 2 times or 3 times the daily return of an index.
Or even the inverse of the index.
Exactly. So you could have a 2x leveraged inverse ETF. Gets complicated fast.
So if the market goes up 1%, a 2x leveraged ETF aims for a 2% gain that day.
That's the goal for that day. And here's the absolute crucial point people miss.
Okay, both inverse and leveraged ETFs reset their portfolios daily.
Daily. What does that mean long term?
It means the compounding effect over time can make their performance drift, sometimes wildly, from the underlying index's longer-term return. They might not track 2x or 3x over a month or a year at all.
Wow. Okay.
Which is why they are almost always suitable only for short-term trading. Like really short-term. Think hours or days maybe, not weeks or months.
That's a critical distinction. Definitely not set it and forget it.
Not at all.
Okay, building on that complexity. Exchange-traded notes, ETNs, where do they fit?
ETNs are interesting. They sound like ETFs, but they're actually debt. Unsecured debt securities.
Debt, so like a bond.
Sort of, but usually without regular interest payments. Their return is linked to an index or a benchmark, just like an ETF.
And they trade on exchanges too?
Yep, trade on exchanges come in inverse and leverage flavors, also really designed for short-term trading.
But being debt.
Yeah.
What's the catch? The big one is issuer credit risk. Since it's unsecured debt, you're relying entirely on the issuing bank or financial institution staying solvent and paying you back.
Whoa. So it's not just market risk, it's also the risk of the issuer going bust.
Precisely. That's a layer of risk you don't have with a typical ETF holding the actual underlying assets.
That is a huge difference. And fees. Similar issues.
You got your brokerage commissions, sure. But ETNs also have recurring costs baked in. Fees tied to the index, daily investor fees. These eat into the ETN's indicative value, its calculated value every single day.
So that daily deduction means your actual return is lower than the index itself, even before commissions.
Exactly. You have to factor that in.
Okay, that makes sense. So we've gone from regulated ETFs and ETNs. Let's step into a different area now, less transparent often.
Yeah.
Private investment pools.
Right. Now we're talking hedge funds.
Hedge funds, big topic. What defines them?
Well, the key is they're private investment pools not required to register with the SEC under the main law governing mutual funds, the Investment Company Act of 1940.
And that means?
It means they have way more flexibility. They're usually sold through private placements, Regulation D, mostly to institutions and very wealthy individuals.
High minimums, I assume?
Very high. Often $1 million or even more.
So this unregulated aspect, what does it allow them to do? And what does it mean for liquidity, getting your money out?
Because they have these exemptions, they can use strategies often banned for mutual funds. Short selling, complex derivatives, lots of leverage, higher potential returns, but also higher complexity and risk.
And liquidity.
That's the other side. Extremely illiquid. They don't calculate or publish a daily value like a mutual fund or ETF. And they have lockup periods and gates, strict rules on when you can take money out.
So definitely not for someone needing quick access to cash.
Absolutely not. You're committing capital for the long term. And the fees, often the 2 and 20 model.
You explain that.
It's typically a 2% annual management fee on the assets, plus 20% of any profits the fund generates above a certain benchmark. It's a hefty fee structure.
Okay. And related to this, but maybe with a different focus, private equity, PE, and venture capital, VC.
Yeah, structurally similar in many ways. Also unregulated and illiquid private pools.
How so?
They also raise money through limited partnership units, sold as private placements, mainly to accredited investors.
But their investment focus is different.
Generally, yes. PE tends to focus on buying and improving existing private companies, while VC focuses on funding early-stage startups. Less about trading securities, more about building businesses.
But still illiquid. No public market for those partnership units.
Correct. Same illiquidity issue. Long-term investments.
Okay, let's switch gears again. Real estate. We hear a lot about REITs, real estate investment trusts. What's fascinating here is they seem different again, regulation-wise.
You're spot on. They are different. While they pool money like investment companies, they are specifically not regulated under that Investment Company Act of 1940.
But they are regulated somehow.
Oh, yes. They fall under the Securities Act of 1933. So if they're offered publicly, they need a prospectus, full disclosure.
So what are they doing?
Essentially, a REIT creates a portfolio of income-producing real estate. Think apartment buildings, shopping malls, offices, warehouses.
And investors get a piece of that.
Exactly. You earn profits primarily from the rents collected. It's a way for regular investors, retail and institutional, to get exposure to large-scale real estate.
Making that kind of asset class accessible. What different flavors do REITs come in?
There are 3 main types. First, mortgage REITs or Mellards.
They don't own buildings?
Nope. They finance real estate, they lend money or buy mortgages, and make money on the interest spread. Like a bank, almost.
Okay.
Equity REITs. These are the most common. They actually own and operate the properties.
Yep.
Generate income from rents.
Got it. And third?
Hybrid REITs. As the name suggests, they do a bit of both own properties and hold mortgages.
Right. Now, the big questions. Liquidity and taxes. How easy are they to trade? And how are they taxed?
It varies. Most REITs are listed on major exchanges, so they trade just like stocks. Pretty liquid.
But not all.
Correct. There are private REITs and non-traded public REITs, which are quite illiquid. Hard to sell, hard to value, much like those private funds.
Okay, good distinction. And taxes.
Yeah.
This is often touted as a benefit.
It absolutely is. It's a major advantage. Under the tax code, if a REIT distributes at least 90% of its taxable ordinary income to shareholders as dividends,
Yeah.
then the REIT itself doesn't pay corporate income tax on that distributed income. It avoids the double taxation that hits most corporations.
So the income is only taxed once.
Yeah.
At my level as the investor.
Exactly. Huge benefit. However, there's a slight catch for you.
What is it?
Those dividends you receive are generally taxed as ordinary income, not at the lower qualified dividend rates that apply to many common stock dividends.
Okay, so higher tax rate potentially.
Potentially, yes.
Yeah.
But the 2018 tax reforms helped here significantly.
Wow.
They introduced a deduction where 20% of qualified REIT income is deductible for many taxpayers. Plus, the top ordinary income tax rates were lowered, so the after-tax return improved quite a bit.
That's good to know. Do REITs have to jump through hoops to get this tax treatment.
They do. They have to meet specific tests, like deriving most of their income 75% or 95%, depending on the test, from real estate-related sources like rents and mortgage interest.
Makes sense. They have to actually be real estate investment vehicles.
Precisely.
All right, let's tackle our final category, and this one, arguably the most complex. Direct participation programs, or DPPs.
Definitely complex.
The unique thing, as I understand it, is that the results, cash flow, profits, losses, flow directly through to investors for tax purposes.
That's the core concept, pass-through taxation.
We're focusing on limited partnerships here. Let's unpack that basic structure. Who are the players?
Okay. In a limited partnership, you absolutely need two types of partners. First, the general partner, the GP.
The manager.
The manager, exactly.
Yeah.
They run the show, make decisions. Crucially, they have unlimited personal liability for the partnership's debts.
Unlimited. Wow.
Yes. They also have to contribute some capital, usually at least 1%. And they have a fiduciary duty, a legal obligation to act in the best interests of the other partners.
So the other partners are?
The limited partners, the LPs. That's typically you, the investor.
Passive road.
Entirely passive, no management control whatsoever. You contribute capital, often the vast majority of it, but your big protection is limited liability. Meaning you can only lose the amount you invested. Your personal assets outside the partnership are protected.
Okay, so that's a key protection.
Yeah.
What are the big draws then, the advantages of these LPs?
So number one is that favorable tax treatment we mentioned, the pass-through.
No double taxation like a regular C Corp.
Correct. Income and losses flow directly to the partner's personal tax returns, reported as passive income or loss.
And the 2018 tax changes helped here too.
Yes, same benefit as REITs, that 20% deduction on qualified business income often applies, plus the lower top ordinary income rates. It made pass-through entities generally more attractive.
What else besides taxes?
Limited liability for the LPs is huge, as we said. And diversification. These programs often invest in things like real estate, oil and gas, equipment leasing, assets that may not move in sync with the stock or bond market.
Interesting. Tax benefits, liability protection, diversification. Sounds good, but what are the catches? The disadvantages?
There are significant ones. Lack of control for the LPs is a big one. You're relying entirely on the GP's skill and integrity.
And we already mentioned illiquidity with private funds. Same here.
Absolutely. Often even more so. There's usually no public market at all for LP units. Selling often requires the GP's permission, which might not be granted. Your money is locked up, potentially for many years.
Okay. What else?
Tax complexity. While the pass-through can be beneficial, it makes your personal tax filing more complicated. Plus, the value is sensitive to changes in tax law.
Right. Tax laws change.
And one more big risk, capital calls.
What's that?
The GP might require LPs to contribute more money after their initial investment if the project needs extra funds.
And if you can't or won't pay?
You could actually forfeit your entire existing interest in the partnership. It's a serious risk.
Wow. Okay. So how do these LPs get offered to investors in the first place?
Two main routes. Public offerings, where the GP hires an underwriter, often called a syndicator, to sell the units.
Registered with the SEC prospectus.
Yes, registered, full disclosure via prospectus. But, and this is key, even though they're public, they're still generally illiquid and not listed on exchange. Max underwriting compensation is capped at 10%.
And the other way.
Private placements. Under Regulation D, same as hedge funds, exempt from SEC registration. The sponsor finds accredited investors directly, maybe through brokers, and disclosure is via an offering memorandum, not a full prospectus.
Got it. Now, these DPPs, these limited partnerships, often focus on specific sectors, right?
Yeah.
We'll touch on the big ones. Real estate and oil and gas.
Definitely the most common. Within real estate LPs, you see different strategies.
Right.
Raw land partnerships.
Yeah.
Pure speculation, hoping the land value goes up, no income, no depreciation benefits, high risk. New construction, building something new, aiming for appreciation once it's built and rented out, usually involves debt, leverage, offers some potential cash flow eventually, plus depreciation.
Makes sense.
Existing properties, buying properties already operating, more predictable returns, immediate cash flow from rents, plus depreciation deductions. Generally lower risk than new construction.
And you mentioned government housing.
Right, government-assisted housing. Investing in affordable housing projects, often under Section 8. The main draw here is usually significant tax credits, rather than just cash flow or appreciation.
Okay, interesting mix in real estate. What about oil and gas LPs?
also a range of risk profiles.
Hmm.
Exploratory programs, sometimes called wildcatting.
Sounds risky.
It is. Drilling in unproven areas, searching for new oil or gas fields. High risk, high potential reward, often high tax deductions for drilling costs.
Then less risky.
Developmental programs, drilling near existing proven fields. Lower risk than exploratory, potentially lower returns, but still significant tax benefits from drilling costs. You also see balance programs, which do a mix of both exploratory and developmental drilling to try and balance risk and reward.
And the most conservative.
That would be an income program. These don't drill at all. They buy interest in wells that are already producing oil and gas.
So immediate cash flow.
Exactly. Lower risk, focus on income and maybe some diversification.
Yeah.
Good for more risk-averse investors, perhaps.
So quite a spectrum within both real estate and oil and gas. Bringing it all together then. For someone looking at these DPPs, what does it all mean? What are the critical takeaways on risks and rules?
It means you have to be acutely aware of the broad risk components. You're exposed to the GP's management skill or lack thereof. The inherent illiquidity is huge. Potential loss of your entire investment. Those possible future capital calls. Rising operating costs. Finding good properties or leases. Changes in tax laws, environmental regulations. It's a long list.
A lot to consider.
Which leads to crucial investor certification requirements. Your broker, the registered representative, must tell you about the lack of marketability and liquidity.
They have to make sure you understand you might not be able to sell.
Yes. And they need reasonable grounds to believe you have enough net worth and income to handle losing your entire investment. Suitability is paramount here.
And one more point you mentioned in the outline.
Critically important. The registered rep cannot use discretion when recommending DPPs. They can't just buy it for you because they think it's a good idea.
So I have to explicitly agree.
Your explicit written approval is required before any purchase. It ensures you've actively consented to taking on these specific risks.
That seems like a vital protection for investors, given the complexity.
It absolutely is.
Wow. Okay, we've covered a lot of ground today, from relatively common ETFs through REITs and into the deep end with these complex direct participation programs.
Quite the journey.
Each one really a distinct world, offering unique ways to invest beyond just stocks and bonds. I hope listeners had a few aha moments understanding the structures, the risks, the tax angles, how different these really are.
And remember, just knowing the terms isn't enough. It's understanding how they work and why they exist. These different structures serve very different needs and suit very different investors.
Right. That knowledge really empowers you.
Exactly. It helps you look at your own financial picture with maybe a wider lens.
So, as you mull over everything we've unpacked today, here's a thought. How might really grasping the mechanics and the specific requirements of these alternative investments change the questions you ask? Could it lead you to think more strategically, maybe more diversely, about your own financial path? Something to consider.